How's it going, everyone? Welcome back to the show. Today, we are joined by Nick DeAngelo, who is the founder of Saint Investment Group, where they focus on industrial as well as income funds. They have a robust background in this industry. Nick has actually been on the show before. We will link to that in the show notes page. Nick, welcome to the program.
Hunter, my friend, longtime friend, just to brag on you to your audience, guys. Hunter was the first person to ever get me on stage in the real estate sector. He twisted my arm and said, "Hey, you got to go on stage tomorrow." Since then, I've been able to do a lot. I owe a lot to Hunter, and he's one of the people that I respect most in the entire real estate space. So, my friend, it's good to be with you today and catch up.
Dang, that's true. So we got you on at the retreat, and then you got the big red carpet at RaceFest a year later, which was awesome. So good for you, man. You absolutely crushed it at both. And something we were talking about behind the scenes not long ago. Dude, one of the things I love right now is that obviously you are a operator in the space, which is awesome to see. But you've gotten a lot of momentum doing these webinars with the focus on trending topics, economics, interest rates, the future of the United States economy. And I'm sure you're just learning so much. You've always been ahead of the curve, but learning so much to create this content. I wanted to have you on because I want to hear your perspective on a couple of things. Let's just start with the number one data points you're looking at right now and how this impacts your investment thesis.
Great question. So, like you said, we dig in very heavily. A lot of that is because we want to be ahead of the curve in what we're investing in and the reasons why. And so that often coincides with a lot of what our high level investors are asking about, et cetera. And we get the advantage of hearing their thoughts, their concerns. And then we dive deep and provide these webinars where we're going in hour, 2 hours on these topics. The top things that I'm seeing right now and also hearing from our most sophisticated investors, people that are, multiple nine figures, et cetera. One, concerns about the stock market, and two, concerns, pros and cons. Let's just say that, just questions about the impact of tariffs, geopolitics, the future of manufacturing, et cetera. So those are the top topics that we're digging into and hosting webinars and diving deep on. And that all relates to also how the US government is operating themselves. So between those things, that's what we have our eye on right now.
Okay, let's jump into it. I don't know where you want to put the stock market discussion in because I want to play some kind of devil's advocate regarding stocks. And this is something I've been excited to do for a while. So you're the right person for it. So where do you want to start? Can we start with tariffs? Because this is like the most trending topic right now.
Absolutely.
What does this mean, right? Is this, Trump has been talking about these significant tariffs, Canada, Mexico, China, et cetera. What's your view on, is this political positioning versus real economic discussion? And if it is real, what is the implications as a real estate investor?
So that's the perfect question. The first is what's going on? And then two, what do we do about it? How do we make money? How do we navigate? How do we protect ourselves? Tariffs. So I'm an industrial investor for well over a decade. It's my favorite asset class by far. So tariffs are very close to home, to say the least. Okay.
And why is that, just for context?
So I'm an industrial investor because one, I like the backbone of America in a way where manufacturing, distribution, et cetera, it's in hard assets. It's in very real and tangible things. And I think the drivers of industrial are actually easier to track once you understand them than many other sectors. I also like the lease types, triple net, et cetera. But what I'm seeing and what I'm interested in on the tariff side specifically, because it completely reshapes the map, not just globally, but especially in the US and especially for manufacturing. Trump's had this interesting trend, and whether you love him or hate him, this is not a political discussion. This is more a strategic discussion. He talks about tariffs. He talks about what he's going to do about tariffs. The market reacts, typically negatively. We see the stock market particularly start jumping around and dipping, et cetera. And then as it gets closer to the tariff taking effect, most people assume that there's going to be some degree of that other country, bowing down or backing off on that. We have seen that. Colombia is a good example, and, others, et cetera. When the tariff actually hits, Or when it's the day of, we see often another dip or other things because they don't actually think, most investors don't actually think that's going to happen. So there's this trend that keeps repeating itself over and over where the market's unsure of what Trump's going to do with these tariffs. So that's an interesting market effect of it. But let's say that Trump was dead on and this wasn't just a negotiation tactic and he had the full intention of moving forward with all these, which is where we get into more tactical, what do we do as investors? It's interesting. I believe that tariffs and manufacturing are actually a domestic security issue as much as they are an economic security issue. So if you look at a company just as the most obvious example, you look at Apple Computers, right? Tim Cook, pretty well-known CEO. He's a gay man, and I only bring that up because he's very outspoken on many topics like, human rights, environment, etc. There's one thing to note about Tim Cook, one of the smartest CEOs we've ever had. His company today, Apple, most valuable company in the world, is valued almost as much as the Dutch in East India Trading Company at its peak. To give you perspective, right? To give us all perspective on that. Tim Cook, even as outspoken as he is, does not ever talk about human rights issues in China. Why is that, right? I mean, despite there's the Uyghur crisis and all these things, we're dealing with a situation where Tim Cook, the most valuable company in the world, CEO for that company, knows that the day that President Xi wakes up and chooses to flip the switch or lock the doors on Apple computers, that's lights out. That's the end of that party. So tariffs are interesting because it's making companies, it's forcing even companies like Apple to reevaluate the dollars and cents and the full load and cost of what it means to do business overseas. Now we're seeing Apple having investments in the US that they're contributing 500 billion over the next decade that they've committed to. We're seeing Honda bringing manufacturing to Indiana away from Mexico. We're seeing Taiwan Semiconductors. I think they're in Arizona, right? Is their new, and so these huge, highly valuable, highly important market moving companies moving stateside in the United States, bringing jobs, bringing wealth, bringing information, bringing new technologies here. So I think it's national security. And I think there's huge opportunities for investors that want to be on the right side of that, whether that's the infrastructure around it, like multifamily. You have to support this with people living places, or my favorite, industrial, where the actual manufacturing and research and development takes place. So it's an interesting layout that we have with the tariff world, and I think it benefits the U.S. long term, but short term, we're obviously seeing some pain in the markets.
Okay, interesting. So, and yeah, to your point, the largest international investment of all time was $65 billion. Taiwan Semiconductor building a plant in Phoenix. And then they recently announced that they were adding an additional $100 billion to that investment, meaning that it was the largest at 65. So now it's the largest by at least another 100 billion. This is insane. And it's obviously very good news for the Phoenix market, as well as some of these other markets that you're talking about that are the recipient of some of these international and domestic investments. Okay. So I can see how that will play a role in those localized markets. Why do you think the stock market is so volatile based on this topic? And you mentioned that you're pretty bearish on your outlook. Is now a good time to talk about that?
Yeah, absolutely. So I'll say this, that I beat up on the stock market. I've been beating up on it for years, and it's nothing personal. It's just as investors that we deal with on a regular basis, we get feedback of what their thoughts are and dig into that and regularly see our own numbers. What we're seeing in the stock market is not a recent trend. I'm not talking quarterly. I'm not talking annual. I'm not talking last couple years post-COVID. We're looking at 30-year trends in the stock market, and they are very alarming. The number one trend I'm seeing in the stock market is that over the last 30 years, the number of companies has reduced by over 40%. So that means a few different things. One, that's a shocking stat just on its own. But two, diversification in the stock market is going out the window. And if there's any stat that's scary to back that up, it's that the concentration of wealth in the stock market is the most it's ever been. The top 10% of companies in the stock market represent over 75% of market value. So historically, I would agree that there were opportunities, in American history where the stock market was an incredible diversification tool. I just don't see that today. Not only that, I actually don't even think the incentives are for private companies to go public anymore. So while the stock market shrank by 40%, we see that private equity has done 6x the investment into small companies, to businesses. So private equity is booming. They're getting access to the best opportunities in the private sector of business, while the stock market is not getting those best opportunities. So those are the concerns that I have looking at that is, so what do we do about it? What's that mean for the future? And why are the incentives the way that they are? This is what we're kind of drilling down into now.
Okay. I'm so glad we're talking about this. I haven't talked too much about this topic on this podcast, but you're the perfect person for it because you got the personality for it. I think you know where I stand in terms of my portfolio. And so we're going to get into this a little bit. Here's where I wanted to go with this. When I got into this game, and it's teed up perfectly for this conversation. When I got into this game, 2010 or so, everything had been beaten up. Real estate had been beaten up. The stock market had been beaten up. And then as things started to recover, let's say 2014, 2015, et cetera, basically every real estate crowdfunding website, which was a boom that took place around that time, was always comparing returns. They were comparing returns of the stock market versus real estate and over the long term, this, that, and the other thing. Many of you may have noticed that those comparisons are gone now. They used to be front and center. Right below the logo and the header, it would be a comparison of the returns. And they're gone because real estate has taken a bath while the US stock market has increased dramatically. Now, you just alluded to it a little bit, but what are your thoughts on this? How have we gone from real estate crushes the stock market to, geez, I mean, all you had to do was keep your money in the S&P 500. You would have probably ran circles around most real estate strategies. What are your thoughts on that?
I love this question because it's really the root of what we're talking about. So the stock market crushing real estate. Let's just use that as the headline for that period of time that it was doing that. What was happening in the background with the capital markets? That's my biggest question here. And the answer is we have this interesting generation called the baby boomers. They're the largest generation we've ever had in US history. They're also the wealthiest generation we've ever had in US history. The baby boomer generation today represents over 75 trillion in US wealth. Okay, just US.
Wow.
So staggering numbers. Yeah. The US GDP is what, mid 20s, 23, 24. So we're talking the baby boomer generation sits on the revenue of the US government annually by 3x right this second. These are staggering numbers. So the baby boomer generation, at that same time that you're quoting, where the stock market was seeing record returns year over year, everyone's high-fiving, we're all brilliant geniuses. It's not the market, it's that everyone's so smart, right? That's a bad sign in general. What we're seeing with the capital markets there is that 75 trillion concentrated in the baby boomer demographic. It was also their highest earning potential that they would ever have in their career, meaning their children had left the house, meaning their biggest expense was now gone. And they were also at the tail end of their careers, meaning they had the most experience, they had the most C-level suite seats, they had the best opportunities and the highest earning that they would ever have in their lifetime while having the lowest expenses. So sitting on all that cash and then also having an environment of near zero interest rates for that period of time, that's steroids. That's called steroids for the market. That boosts companies, that gives tech companies these ridiculous access to ridiculous amounts of capital, really all companies, but tech can take the most advantage of it with more of a growth model. We saw stocks boom so heavily that now we're in a point where we're just getting whiplash. We don't even understand where the stock market's at. But if you expand the trend beyond the last 15, 20 years or so, you see that we're almost returning back to more norms. Just like there was 10, 15 years of the stock market absolutely pumping, there is 10 to 15 year periods where the stock market was flat, right? Flat. So with inflation, you lost money, right? So where we're sitting today with the stock market, baby boomers are out. They've taken their 75 trillion largely. They've moved on to more conservative investments like bonds and fixed income and other assets. So they're not competing for yield like we saw so heavily in that time. And now rates have gone from, let's say, the 3s to the 7s, right? Maybe higher in many sectors, many sectors. So we don't have that amazing access to cheap capital that we had. We don't have that a huge amount of 75 trillion bidding down return profiles on investments. And largely we have a situation where, not to get overly geeky on the economic side, but a Phillips curve where inflation and employment are way out of whack. So we're in the wake of probably the biggest capital influx, the biggest investment influx and the largest demographic influx that we've ever had. And now we're rebalancing those books. And the stock market also has 40% less companies to spread the risk around in.
Totally. So I talked to my partner Tyler about this. I was just, kind of going back and forth, and there was some gravity to what I was saying. Because listen, as someone who goes through market cycles, you try to create rules of thumb so that you don't allow the market to dictate the decisions you make. You try to make rules of thumb that stick with you regardless of the market. And so I was just trying to hold myself accountable, because one of the claims I always had was like, listen, number one, the returns are higher. Now, granted, the returns should be higher because it's not liquid when you invest in real estate. But then it's like, holy crap, if the returns aren't higher and you're getting hit with a lack of liquidity, we're going to have to reevaluate our model, or at least double click on the data. And, him and I were going back and forth, and he was like, look, dude, not only is it that I think you said 10% of the companies represent 70% of the value or something like that.
That's right.
It's also like 4 companies represent like all of the gains. So it's like all of the gain, like something, you can look up the number. He knew the number offhand, but it's like, there are 4 companies, tech companies, that exploded and make the entire stock market look like it crushed it, when it's not like Johnson & Johnson. Well, that's a bad example because of the COVID stuff, but you get my point. What's a great example? Walgreens. They're basically cooked, right? Isn't that right? They're basically on the, okay. So that would be but when you have a massive company that goes billion, 100 billion, it weights towards that. But like Tesla, for example, is a good example of this, where what is the actual net profit there? And is that really an example of speculation and funny money and low interest rates? Give you a very skewed view of what the returns should be. Now, I know this seems interesting because I thought 15 years was a long time, right? It's like, certainly that would be enough sample size where it would kind of wash out all this other stuff. But I got to be honest with you. I think your case is pretty convincing. Just wait. Let's see what happens, because we haven't had a recession. Can I ask you a question that's offhanded, but it's related to this?
Absolutely.
Given what has happened with real estate and we haven't had a recession, what are your thoughts on A, whether or not we're going to have a recession in the near term, let's say the next 24 months, and B, what does that mean for real estate if we do, because it's already been so beaten up and started to recover? What are your thoughts?
I think that's a great question, and I'll give you my honest to God, close to my heart thoughts. The first is, I actually genuinely 100% believe that the Federal Reserve and Jerome Powell would be very open to a recession, candidly. I think that if you interpret some of his public comments, you can read through the lines and see that he's not 100% against it. That's maybe not. Here's what I know with high confidence. I buy a lot of mortgages. I operate in the mortgage space. I know a lot of bank CEOs, and I have that amazing ability to check in with them on what they think is going to happen in the market. Many of them are close to Jerome Powell. Let me just leave that there. The feedback I've gotten is that Jerome in private has made it very clear that a recession would solve a lot of our problems. Because again, I alluded to the Phillips curve. It's that swinging balance of employment versus inflation. That is so insanely out of whack right now, which is the dual mandate of the Federal Reserve. On one hand, you have employment, and on one hand, you have inflation, keeping those under control. Sorry, go ahead.
When you say it's out of line, what do you mean by that?
You're dealing with, high employment. Well, historically, I think there's a lot of rebalancing happening today, but you're dealing with employment that is very high and inflation that's very high. Right. So, and then you're starting to see things like layoffs at the government level. You're starting to see layoffs in big company level. You're starting to see Facebook, post, hey, we're laying off this many, et cetera. And we have high inflation. So it's almost like the employment data is going backwards and we have high inflation. That's usually, you see it as a seesaw and you're trying to find the balance if you're the Federal Reserve. If both are going in the wrong direction, that's out of balance historically for the Phillips curve. That means the Federal Reserve is failing on both sides of their dual mandate. Whereas a recession, I'm being told of what some of the discussions with Jerome Powell are, would rebalance that. So one, I think there is an incentive at the Federal Reserve level to maybe a shallow recession. Maybe nobody wants 2008, right? But I'll tell you my personal take on it to answer the other half of your question. I'm okay with a recession. I understand that's not popular. I understand that I'm probably not going to get a round of applause for that. But I'll tell you that just like you, I entered the market in arguably the worst real estate conditions in the history of the real estate market, right? And so the Great Recession was extremely turbulent. The big five banks had discussions of them failing at the time. I don't think we're dealing with that today. We had record foreclosures. I don't see that today, although I have the delinquency data on hand. And I feel very comfortable in down markets because I believe there's more opportunity in down markets than up markets, especially for real estate. So, do I think there's a recession coming? I'd say there's certainly a rebalancing. I think the stock market, if you look at, I believe it was Goldman Sachs, their estimate for the next decade of the stock market is an average of 3% return per year.
Hmm.
Okay. Goldman
Hmm.
Sachs, right? With all the analysts in the world. So I think there's more of a stock market recession on the future. I
Yeah.
think real estate's definitely getting kicked in the shin right now. You
Yeah.
look at delinquency rates of commercial in particular, and I'm not concerned about most real estate asset classes over like a 5 to 10 year horizon, but I definitely think there's pain in the short term.
Okay. So essentially, if there is a recession, all the pain that we've had in real estate is mostly due to interest rate rise and very little to do with underlying fundamentals. Sure, there's been additional supply that's come on, and particularly in multifamily, but that doesn't create massive problems. That creates like 8% concessions and stuff like that. Depending on your LTV, that isn't going to make or break your model. It'll create some headwinds, but it's not going to break your model. Having your interest rate double on an 80% leverage deal, that will break your model because no one thought that that would happen and you didn't account for that. And if you would have, you wouldn't have been able to buy the asset because you would have bid so low that your competitors would have paid more than you because they weren't doing that. So that's really the situation right now. But you're talking about the underlying economy slowing down potentially significantly. I could see how that could impact rents. Do you think that valuations have a place to fall? I mean, there always is a place to fall, but do you get where I'm going with this? It's just when you see 25% reductions across multiple asset classes in real estate, that alone is historically significant. To go down another 10%, now we're getting in 2008 levels. What are your thoughts?
I'll tell you this, the best advice I ever got on acquisitions, right? On where to enter into a property at the best value was from a guy he's right around the billionaire status today. He's one of my early mentors. I was very blessed to even have access to him in his family office to work for it and operate for. His famous quote to me that sticks out in my mind above all others is, Nick, never buy for price per perfection. Never buy at a really high valuation. Always be looking for a fair price for a high quality deal, which he kind of borrowed from Warren Buffett, that idea. What his point was if you buy at the tippy top or you buy at a very, difficult high price, you must operate at perfection because you're paying for X amount of years in the future. So certain multifamily markets at the peak were like 3.3 cap. I mean, you might know better than me, Hunter, but you're buying 33 years of income up front, right? So that is a price to perfection model of certain markets like that. Industrial saw a lot of the same mini discussions at the 4 cap rate, which for industrial does not make sense. It's not propped up by the government like multifamily is. So all those to be said, I think that you talked about rates, which have usually a direct correlation, or an inverse correlation to property pricing. I would say that rates settling around that 6% rate for a long period of time, 5 to 6% range for a more extended period of time is going to very, very likely be the case, is what we're seeing with inflation data and pressures, et cetera. And if you look historically, that's a return to norm. That's not a bold statement, right? That's just me taking data and saying, hey, if you just wash out these extremely low years that we had, we're kind of just back there to the norm. So I do think pricing will have to adjust, right? And I think there's always a permanent discrepancy between buyer and seller expectations. I don't think that that's going to align anytime soon, but I think there will be good deals in the market. And I think that the market will show who actually needs to sell and who doesn't. And it's going to be a bidding war in a lot of areas and a big fight out for things. And then other areas, I think that you're going to have opportunities to buy things below market, off market, owner user type situations in the industrial sector, particularly. And I think it's definitely that pricing is going to resettle at a lower number, much lower than the peaks that we saw a handful of years ago.
You brought up rates. Let's talk about rates, and let's talk about the 10-year treasury particularly, because rates is a broad term and different asset classes, different markets, different agencies are going to price things differently. But most assets, at least in multifamily, are based on the 10-year. At least that's what the agencies are based on. So what's your view of where we are right now? As of the recording of this, we're at like 4.2 or something like that in the 10-year. We've seen about 20 bips from recent highs in like the 4.5 range. What is your perspective on where that's going over the next 6 months?
I think I'll give you both answers. I'll give you the government answer. I think Trump wants low rates. I think he's been very completely aggressively outspoken on that.
Yeah.
Just to be super clear. So I think he's targeting everything to put downward pressure on rates. That could go into a recession discussion. That can go into a tariff discussion, et cetera, et cetera. But I think that the government target of bringing rates down is absolutely a goal for the government. I think what gets complicated is inflation. On the other side of that, we saw over 9%, 9.1% inflation mid 2022, which was only 18 months after Janet Yellen said, inflation's transitory. Don't worry about it. This is going to go before you know it. So I think Trump has his hands full. I think the government has their hands full on the Fed to balance the inflation discussion with rates. But with the recessionary issues that we're having today, and with Trump having 3 years in office ahead to really kind of get this back on track and get things going, I think they very much could achieve lower rates, and that's a goal. My serious concern is that nearly every Trump policy is pro-inflationary. At the end of the day, it's either pro-recessionary or pro-inflationary, most of them. Although over the long term, I think a 10-year plan, many of them are smart. Cutting government spending, cutting government jobs, right? If they cut 10% of the government jobs, that's 2 million jobs that will be entering the unemployment pool. Okay. That should take probably 18 months to filter into the private sector. Okay. But the good news is 2 million new people into the private sector can actually cause GDP growth. You can't hire more jobs into the government to boost GDP. But if you cut government spending, you reduce the deficit of $2 trillion a year that we have and repurpose those jobs into the private sector, I think we can actually, in a healthy way, grow the GDP. So on rates, I think it's a government target to lower rates. My bet is that rates stay at where they're at for a longer period of time because things like tariffs, which in the short term are going to raise prices on goods most likely, and the build out of the manufacturing sector in the US, which is also inflationary, is going to take 5 to 10 years is the reality. That's why you deal with Apple making a 10-year promise of 500 billion, not a 1-year promise, right? So short term, I don't see rates. I think they're going to be a lot stickier. I think that inflation's a lot stickier than we're giving credit for. I think it's going to be around for a lot longer. And if there's a recessionary movement where things start dipping, especially stocks, which are very front and center, and reduce consumer sentiment, I think rates should stick right where they're at for an extended period of time, maybe bounce slightly up, slightly down, but I'm seeing rates be pretty steady for the next handful of years.
Super interesting. So I'll kind of share my perspective on this and we can go. We
Please.
talked a little bit about rates, but I'd like to talk a little bit more. So one thing that obviously comes up is that the Fed controls the federal funds rate. They do not directly control the 10-year. And so what some people saw was the Fed go to reduce rates and the 10-year actually go up, right? And so part of that's because when the Fed reduces rates, some people will say, hey, that's bullish. I'm going to risk on and take money out of bonds and put it into the stock market. And so you see actually this happen. You see capital flows go into the stock market go up, and rates, AKA the 10-year, for example, go up. Now, if you're buying real estate, you don't really care what the federal funds rate is. You care what the 10-year is and those other metrics that are more based on market conditions. So just keep that in mind. That's one thing. The other thing, though, is that if we are you probably sensed when Trump was elected, the sector of real estate in particular is like, oh my gosh, overwhelmingly relief and also just very bullish. But I'm kind of getting the sense that excitement has not been met with deal flow. And so it's starting to pass. It's like, oh my gosh, Trump's going to save us. And it's like 3 months later, you still haven't done a deal. It's like, oh, well, we got to figure out another plan. What is your vision of how we kind of move forward, and what does the rest of 2025 look like? Is it that this elation of, to a large degree, Trump's election, which has rippled through the real estate community for obvious reasons, is that subsiding and then is met with the reality of economic situation, which is broadly the same as it was before Trump got elected, which people were pretty scared about?
Great question. I think that here's the precursor to that question, and something that I track to get an idea of a gauge of what's coming up. You talked about one of the biggest ones that I track, and it's new inventory coming online. Okay. New inventory coming online. Multifamily had a record couple of years of bringing inventory to the market. So did industrial, although industrial is a lot less sexy and a lot less front and center. I would say that I would applaud multifamily and industrial for how resilient both asset classes were despite these massive amounts of construction coming online. Okay. So that's one aspect. Is I don't see that for 2025. I see a huge reduction in inventory coming online. So where we can actually get back to real market dynamics, where there's not these huge blips that kind of shake the markets in that way. I think we're coming back to a stabilized market in that regard. The other thing that needs to get sorted, other than new inventory, which is more of a physical side, the financial background of these spaces and delinquencies, particularly. So you look at office, it went from 3 to 17% in about a year, from 23 to the end of 24. You look at industrial, went from 0.2 to 0.8. These are all increases in delinquency.
Okay.
And so retail, they were already doing poorly. And I love retail. I'm really rooting for retail, but went from 9.2 to about 10.9. So you look at these delinquencies, there's a portion of markets that I believe will be dragging pricing down necessarily. I think banks have been kicking the can for the last 2 years because there's so many things that were moving along. I'm seeing the banks that we're close with starting to move towards actual foreclosures, starting to actually put pressure. They'd love to take multifamily property back, right? They would love to get that because there's a line of people that would be happy to do that. Industrial as well. Office, I don't think so. I think they'll kick the can on it. So that said, of where that brings the market, I think deals get done in 2025. I'm most close to industrial. So I'll put it this way. My target for entry point, industrial is a weird sector because most of the buildings we look at have one tenant.
Okay.
Okay. So if you buy a deal and you tenant that at a early point in the market, you have to deal with 5 years of below market rents.
Yep.
That is not attractive to investors. So the entry point in industrial is very, very, very sensitive. Whereas other spaces like retail, multifamily, office, you can typically ride up and ride down the tenancy.
For sure.
Industrial, I think the entry point is middle of the year, that there's going to be really good opportunities that start to really make sense. Multifamily, I'm not as close to, but I think that there's a lot of opportunity to be buying now in some distressed sectors. And that I think that many markets are going to see opportunities where things are coming online at, discounts 20+% off from the peak.
Yep, 100%. And we're seeing that across the board. We still have additional supply coming on in 2025. The second half is different, but then it changes dramatically in 2026. And then it just falls off a cliff in 2027 in multifamily. At least that's what's planned. And in order for that to change, they would have to start today to impact 2027. And that's just not happening given where interest rates are. It's going to be a really interesting rise. But, Nick, you mentioned before you started your career at pretty much I don't know how you describe it. I think you said the worst or the toughest market. For context, he started after the price reduction. The toughest market is 2005. That's how you get whipped on your first go. And then I don't know if we're sitting here having this conversation. If you and I had both started in 2005, would we been able to recover emotionally, financially, spiritually from what we went through? We both know some people that did start in 2005, and Matthew Owens is one of those guys that those are horror stories that it takes you time to get over. But my friends, anyone that's been through cycles will tell you that right now is the freaking go time. It's going to be a lot different in 2027. But if you can start building your network, your confidence, your underwriting skills, your relationships, developing the softwares that you want to use now, By the time we get to 2027, it's going to be on. So Nick, I'm excited to have you on in the interim, but also just watch this wave come on. Before we jump off though, let the listeners know how they can learn more about you, your show, your webinars, etc.
Sure. So the best way that we can give back to the investment community, we just do free webinars because we're doing all the research already. So we have all of it compiled. We just put it forth for our investors and for the investment community. You can find all the webinars, the long form webinars we've done for free at saintinvestment.com/resources.
Love that. We'll link to that in the show notes page. Nick, thanks a bunch, man, as always.
Hunter, always great to see you, man.
Boom. Thanks a ton, dude.